In this video, we want to become clear on the concept of hedging. What is hedging? Well, hedge actually does come from an Old English word that literally meant a fence, and typically a fence that surrounds something. And that's what we're going to talk about with financial hedging. It is to put a border around the amount of risk that you're taking on, to limit your risk. So in financial terms, the act of hedging is taking on an action that is meant to offset or reduce the risk from some other action that you've already taken. You may not realize it, but in your own life, you do hedging. For example, life insurance. So I have life insurance because I have a family to support. There's a risk for me just from being alive, right? I get in a car and I drive to work each day. I don't always eat the healthiest food, and there is COVID virus, so I am always at risk of death before I would like to die. So to offset that risk, I purchase life insurance so that if I were to die earlier than I would like, my family will at least get some financial resources to help offset the financial pain of losing my income. But how about health insurance? So just being alive, you are at risk of getting ill. Being treated by doctors and hospitals can be very expensive. So to hedge against that risk that you end up with very large hospital bills, you should be purchasing health insurance. And if you're not doing that and you have a car, hopefully you at least have car insurance, because every time you drive the car, there's some risk that something negative happens, that you get in an accident. Even if you are the safest driver, you can't control everyone else. So there's always a risk that someone else has an accident that damages your car. So to offset that risk, you purchase car insurance so that if you do get in an auto accident, the insurance company will take some of the cost involved of that accident. And by taking these hedging activities, it can reduce your stress level and allow you to drive the car without as much stress and live life without as much stress. So that's what hedging does. It's taking an action to reduce some other risk that you have. In summary, hedging is taking an action with the purpose of offsetting some other risk that you already have and can't eliminate. So thankfully, there are companies willing to take the other side of the risk. So when a company sells me car insurance, they are making a bet that I will not have an accident. Okay, so why would you go to the trouble of hedging, especially in a business setting? Well, there are certain things that you just can't control, and you don't want to be distracted by those. So it's easier to plan your business if you can reduce overall risk or uncertainty. By doing that, you can focus your time on the things you can control. Also, hedging protects against dramatic changes. Without car insurance, that could be very stressful if you were to total the car and you didn't have the money or resources to buy another one. But by having car insurance, you're protected against that dramatic change of going from having a car to not having a car and not having a way to get one. Let's talk about a real company and how it does hedging. Delta Airlines, you can read in their annual report, they have two big risks that they face in running the business. Changes in fuel cost, because fuel is about 1/3 of the cost of running a flight, and changes in foreign exchange rates because they have a lot of international flights and therefore they get paid a lot in foreign currencies. I believe the primary foreign currency they hedge is the Japanese yen. So let's think about, why does Delta need to hedge fuel cost? Well, they will set a ticket price now for a flight that won't even take place for 60 days. Well, they need to know what is it going to cost Delta to run that flight so they know what to charge for ticket prices. They need to be able to lock in the price of fuel 60 days in advance and maybe even 90 days in advance. So one way Delta can lock in fuel cost is by signing forward contracts. The same way in this chapter we're talking about signing forward contracts for foreign currencies, right? That locks in an exchange rate for currencies. You can lock in an exchange rate to give up US dollars and get jet fuel. Well, about 7 or 8 years ago, Delta reported at the end of a quarter a $440 million gain on their fuel hedges. Right? So they had a bunch of forward contracts where they were locking in a fuel price, and they said those contracts went up in value by $440 million. So what does that mean happened that quarter to the price of jet fuel in the marketplace? Price of jet fuel go up or down in that quarter versus the price that Delta had locked in? Hopefully you guessed that that meant for everyone else, jet fuel prices went up. That's why Delta's hedges became valuable, as they had locked in a lower price. So through the miracle of the internet, we can check whether or not that's what really happened. So here is a chart of jet fuel prices for that quarter. I'll even draw circles around the start of the quarter and the end of the quarter, and you can see, yes, jet fuel prices for everyone else went up, but Delta had locked in those lower prices. So that made their contracts very valuable. But look what happened right before that. Jet fuel prices went down. So if we went back and looked at their second quarter for that same year, they would have shown large losses on their hedges. So companies are not signing these contracts to gamble on fuel prices. They're doing it to reduce their risk and to get more certainty on what their costs are. Well, if hedging is so great, why do some companies choose not to hedge? Some airlines don't hedge their fuel cost. So why might a company not do hedging? Well, first of all, as we've seen, it's expensive, right? You have to have employees who know how to do the hedging, who know how to set up these forward contracts, who know how to do the accounting for it. The accounting is complicated. This is a tough chapter, and we're only doing some of the simpler parts of the chapter. So again, you have to have pretty smart people to get the hedges done right, and very smart accountants, and you're paying them a lot of money to get the accounting right. Some companies say they're not going to hedge certain costs because they figure in the long run, things will even out. Some quarters fuel prices will go up, some quarters fuel prices will go down. Maybe Netflix has that attitude. Sometimes the euro is going to go up, sometimes it's going to go down. And one of the last arguments, and this would be true for a publicly traded company that's one traded on a stock exchange, is finance people argue that shareholders have the ability to hedge on their own. So let's take an extreme example here. There are some companies who the only thing they do is they own gold mines and they dig out gold from the ground. So if you are somebody who thought the price of gold would go up, you might think to yourself, I will buy stock in a gold mining company. Now, you would not want that company to hedge the cost of gold, right? Because that would defeat the purpose of you investing in them. You're investing in a gold mining company because you think the price of gold is going to go up. You don't want them hedging away your bet by locking in current gold prices. So that's an idea of what that fourth one means, where shareholders can hedge on their own. If we take it back to Delta, if you invest in Delta, arguably you're partly betting on what's going to happen to fuel prices. So by Delta hedging the cost of fuel, they're removing that bet from the table that you were trying to make. So in summary, what was this video about? It was getting you the idea of what hedging is, how you do it in your own life, even if you haven't thought about it that way, and that hedging does not make the original risk go away. It just tries to balance it out. So hedging is taking an additional action to balance out some other risk that you have that you can't get rid of. The value of hedging is by reducing your overall risk, especially if things you can't control. It gives you peace of mind and the freedom to focus on the things you can control. Why not hedge? It's expensive, it's complicated, and in the long run, things probably balance out anyway without you doing anything.